He told me not to sell because he's worried about it. One of the reasons is bomb.com. Do you happen to have index funds in your portfolio, such as State Street's SPY, Vanguard's VOO, or BlackRock's IVV? All of these ETFs track the S&P 500, which is an index made up of the 500 largest companies in America. These ETFs generally have lower fees and are known for their passive investment strategy, which doesn't try to outperform the market, but just diversifies the bets and accepts the market's average return. However, what if I told you that there could be a big problem with this investment method, which could potentially be fueling the biggest stock market bubble the world has ever seen? Michael Burry, famous for predicting the 2008 financial crisis, noted last year that the only difference between now and the year 2000 is the passive investment bubble that has been steadily inflating over the past decade. So what is this hypothetical passive investment bubble, and how could it endanger our stock portfolios? Let's put it into context first. As I mentioned, passive investing is a common strategy in the stock market, where you buy index funds that track the market, such as ETFs, and simply buy these funds periodically over a long period. For example, over the long term, the S&P 500 index has averaged around 10% a year. So passive investors, rather than trying to beat the market, accept that 10% is a pretty decent return. They choose one of these large S&P 500 index funds, accept the average, and hope that the future will be somewhat similar to the past. If you want more information on how to implement this strategy, I recommend you consult resources such as Investing in the Stock Market for Beginners from Monetary Education. It's no secret that passive investing as a strategy has become incredibly popular over the last few decades. Interestingly, by the end of 2023, the total amount of passively managed money reached a combined total of $13.29 trillion, showing that people are shifting towards the idea that most regular investors won't beat the market. This trend is really interesting. If we look at professionals, we can see that in America, 87% of actively managed funds haven't beaten the S&P 500 in the last 10 years. So it's great to see that people are rejecting the idea of handing over their money to big asset managers who are likely to underperform and still charge fees for it. However, this huge growth in popularity of passive investing also brings its own problems. One of them is the possibility that index funds are in a kind of bubble. There are several arguments to this effect, one of which relates specifically to the S&P 500, which is the most popular index among passive investors. Passive investors are aware that the market is increasingly concentrated in a few companies. It's no secret that in recent years, we've heard a lot about the Magnificent Seven, a group of 7 companies that have led the market based on the future promise of advances in artificial intelligence, AI. These companies now account for an impressive 32.75% of the S&P 500. In other words, only 1.4% of S&P 500 companies make up about a third of the index, while the other 98.6% of companies make up the remaining 2/3. Nvidia alone already accounts for more than 6% of the S&P 500. This level of concentration is worrying, especially for those who invest passively with the aim of diversifying and hedging their bets, ensuring that their portfolio is not overly impacted by the performance of a single company. Currently, however, many passive investors have a large stake in 7 tech giants, whose share prices have been inflated by speculation around AI. For example, if these 7 tech stocks suffered a major crash and each lost around 50% of its value, the S&P 500, which includes America's 500 largest companies, would fall by around 16%. This is one of the big problems with ETFs today. While passive investors seek broad diversification, in the case of the S&P 500, their portfolios are more concentrated than ever, being at the mercy of the movements of just a few very large companies. This is the first part of the ETF bubble argument. Before we tackle part 2, it's time for a quick update on Brandon's book club. As you know, this year I'm focused on reading a lot more, and one of the strategies I use to facilitate learning is Blinkist, which has been sponsoring this channel all year. If you're not familiar, Blinkist summarizes many non-fiction books and podcasts into quick 15-20-minute summaries. This helps you grasp the key points quickly and decide whether you want to invest more time in reading the full book. I recently listened to Philip A. Fisher's summary of Common Stock and Uncommon Profits. Fisher, and I was surprised to see that despite being first published in 1956, the material is still extremely relevant today. The book addresses the inefficiencies of the stock market and how this can open up opportunities for attentive investors. It also explores the psychology of the market and the importance of thinking differently from the majority. There are many other excellent books on investing and finance on Blinkist, as well as summaries on entrepreneurship, marketing, economics, communication, productivity, career, success philosophy, and much more. I strongly recommend that you join Blinkist's community of over 31 million users to enrich your knowledge. We talked earlier about market concentration and the 7 tech giants that really inflate the market capitalization of the S&P 500. However, there is another contributing factor to this idea of a passive investment bubble, which comes down to the very nature of the passive investment strategy. When people invest passively, what are their objectives? Passive or index investors buy, for example, the S&P 500 with the intention of regularly investing in the 500 largest US companies, regardless of what is happening in the stock market or the economy in general. To put it another way, this means that money is invested in these companies regardless of their business performance. Think of it this way. If I analyze Microsoft, for example, the 3 largest shareholders are not Bill Gates or Satya Nadella, but Vanguard, BlackRock, and State Street. These major ETF providers together hold around $576 billion of Microsoft's $3.4 trillion market value. In reality, these positions represent thousands of individual investors who simply own investment products, such as an S&P 500 index fund. Therefore, 16% of Microsoft's shares are held by investors who bought the stock, not because it belongs to Microsoft, but because it is a company included in the S&P 500. This dynamic applies to any company in the S&P 500. The 3 main holders of Procter & Gamble, for example, are Vanguard, BlackRock, and State Street, collectively holding $78 billion of its market value of $388 billion, i.e., 20% of the company is passively held. At NVIDIA, the situation is similar. Vanguard, BlackRock, and State Street hold 19.7% of its market value. In the case of Etsy, which is at the other end of the S&P 500, these same companies hold 28% of its outstanding shares. No matter where you look, these large investment companies have many shareholders who bought shares without the specific intention of investing in them. This causes some market distortions. Michael Burry mentioned in a tweet that the increase in passive investing has eliminated price discovery of shares. Price discovery is the process by which the correct price of a stock is naturally calculated by a market through supply and demand. Burry's argument is that when a stock is included in an index such as the S&P 500, the demand for that stock can inflate its price, regardless of its actual performance, thus distorting the true value of the company. When a company is included in an index, there is suddenly a significant increase in demand for its shares. This is because passive investors start blindly buying that company's shares simply because it is now part of an index. As passive investing gains popularity, this can continue to inflate share prices, especially of the largest companies on the market, which are present in many passive investment products. Michael Burry noted in an interview with Bloomberg in 2019 that passive investing has removed price discovery from stock markets. Simplified theses and models that lead people to sectors, factors, indices or ETFs, and mutual funds that mimic these strategies don't require the in-depth analysis necessary for true price discovery. Over time, this means that more and more shares in these large companies are held not because of their underlying business performance, but simply because they are in an index. This can lead to excessive share price inflation, which is actually the definition of a bubble, when prices inflate for reasons unrelated to fundamental business performance. In 2000, for example, company fundamentals mattered less, as long as the company was putting .com in its name, which is somewhat reminiscent of the situation today. Today, fundamentals seem to matter less and less, while the narrative around AI is driving stock returns. There are arguments for the existence of a passive investment bubble, but the question is whether we are at risk of an imminent burst. It's worth noting that the current scenario is somewhat different from what it was in 1999. Back then, there were weak companies that were manipulating the system and seeing huge price gains by advertising big internet plans, even if their profits weren't actually increasing. This was clearly a bubble. However, today, despite the hype around AI, the profits of these companies are actually rising along with share prices. For example, in the first quarter of 2024, despite the fact that the share prices of tech companies have increased year on year, the profit growth of Amazon, Google, Meta, Microsoft, and Nvidia was 64.3%, while the other 495 companies in the S&P 500 saw a 6% decrease in profits. So although the market is on the rise, the performance of these big tech companies is actually holding up. Another question to consider is what happens if sentiment changes and passive investors start leaving the market in droves. In a tweet last year, Michael Burry mentioned that all the cinemas are overcrowded, and the only way anyone can get out is by running over each other, with the door being too small. This suggests that if too many passive investors try to leave at the same time, there could be chaos in the market, exacerbating falls in share prices. Let's quickly review how this could happen. Share prices are determined by supply and demand, as shares are traded between investors. There need to be buyers and sellers for transactions to take place. If there are many buyers and few sellers, share prices tend to rise. The opposite is also true. If there are too many sellers and too few buyers, the share price will be determined by the most desperate seller. Michael Burry argues that passive investing is creating a situation in which many shareholders own shares without really understanding why they own them. They hold on to those shares only because they are part of an automated investment plan, such as an index fund. Imagining an overcrowded theater. If the market crashes and too many ordinary investors get scared, trying to leave all at once, this could cause a big drop in stock prices. In the stock market, for someone to be able to sell their shares, there has to be someone else willing to buy them. If too many investors try to sell their shares simultaneously, the price can fall dramatically because there won't be enough buyers willing to step in and buy them. This phenomenon is exacerbated by the fact that many passive investors are buying and selling shares amongst themselves without directly impacting the trading volume of the underlying shares that make up the indices. Most ETF, index fund, trading takes place on the secondary market, where passive investors simply trade with each other. For example, Vanguard found that 94% of ETF trading takes place on the secondary market. So despite the high volume of trading in ETFs, this doesn't necessarily translate into a high volume of trading in the underlying shares, even in cases of creation or destruction of ETF units, which cause trading in the underlying shares. The impact is relatively small. A study by BlackRock in 2017 revealed that even during a month with large inflows into ETFs, such as July 2017, 95% of the trading volume in Apple shares was not directly related to ETF flows, despite the fact that Apple is the largest company in the world and is held by 331 ETFs globally. Therefore, it could be argued that the idea of a passive investment bubble is a bit exaggerated. There are concentration risks, especially with technology stocks accounting for 33% of the S&P 500 today, but the situation seems less alarming compared to, for example, 1999. Although it is difficult to predict whether the increase in passive investment would cause significant distortions in the market, In the event of widespread panic, the data suggests that the impact may be limited. I'd like to hear your opinion on this subject. Leave your comments below. Also, if you're interested in learning more about investments, check out the link in the description to the new financial education. Don't forget to like this video if you found it useful, subscribe to the channel for more content like this, and see you in the next video.